Meta reported their first quarter 2024 results, beating Wall Street estimates on both top and bottom line numbers. Despite the positive performance, their stock plunged 11% following release, wiping out roughly $132 billion in market share. The stock closed at $441, down from Wednesday's closing price of $493 before earnings release. So the big question here is, why did the price fall? In this video, we are going to dissect their Q1 earnings release, analyze management's guidance on 2024, and dive into some key points from the earnings call to understand what caused this unexpected drop. Finally, we will also explore Meta's investment potential in light of this recent price movement. But before we get started, please don't forget to smash the like button and consider subscribing to my channel. If you are new to my channel, I share key investing insights to help you become more financially literate and achieve your financial independence goals. You are watching Investing Strategy 101, and my name is Aditya Jain. Let's dive right in and see what caused this unexpected drop, starting with a breakdown of their Q1 earnings release. Meta reported a stellar revenue of 36.5 billion, which is 27% year-over-year growth. That's simply amazing, especially at their current size. Their gross margin for the quarter was 82%, increasing 3% point year-over-year. The operating margin was 38%, growing 13% year-over-year. This is huge. This level of gross margin and operating margin is best in class. This translates to net profit of 12.4 billion, which implies 34% margin, growing 14% point year over year. Now, compared to the revenue growth, the cost of revenue was only up 8.7% year over year higher, and operating expenses only grew by 4.5% on year over year basis. This is what operational efficiency looks like when you grow your top line, but your cost of revenue and operating expenses only grow by a small percentage. Now, let's look at the daily active users across their family of apps. In Q1, it stood at 3.24 billion users, which is 7.7% increase year over year. Again, a huge milestone for the company. Now, looking at their free cash flow statement, which is cash from operation minus capital expenditures, it has increased by 80% year over year to $12.5 billion. This free cash flow allows them to aggressively buy back shares and raise dividends in future. Overall, Meta had A plus earnings release. To summarize again, revenue grew at 27% year over year, gross margin stood at 82%, operating margin greater than 38%. Reality Lab operating loss was 3.8 billion. They repurchased 14.6 billion of Class A common stock and paid 1.27 billion in dividends. They ended the quarter with 58.12 billion in cash and 18.4 billion in long-term debt. The user base grew by 7% to 3.2 billion daily active users. Total headcount decreased by 10% year over year. Shares outstanding increased slightly by 1.1% year over year. Now let's talk about forward guidance from the management. Management is expecting second quarter revenue to be in the range of 36.5 to 39 billion. This was weaker than what the street was expecting. For Reality Labs, management expects operating losses to increase meaningfully year over year due to ongoing product development efforts and investments to further scale their ecosystem. Overall, management is expecting full year 2024 total expenses to be in the range of 96 to 99 billion, which is an increase from prior outlook of 94 to 99 billion due to higher infrastructure and legal costs. They now expect the full year 2024 capital expenditures to be in the range of 35 to 40 billion, increased from the prior range of 30 to 37 billion as they continue to accelerate their infrastructure investment to support the AI roadmap. Management provided no guidance beyond 2024, but they expect capital expenditures to continue to increase next year as they invest aggressively to support their ambitious AI research and product development efforts. Now let's look into some of the commentary that stood out to me from the earnings call that would have triggered the sell-off. CEO Mark Zuckerberg continues to see a big opportunity in AI and the metaverse which require continued investment. The investment cycle for AI and Reality Labs could span over several years, similar to past cycles with stories and reels. Initially, they mentioned the focus will be on scaling the products without immediate monetization. Revenue opportunities are expected to monetize once these products achieve significant scale. Management also expects significant amount of capex and energy going to be required for investments in Gen AI before its full potential can be realized. Initial Meta AI feedback is very positive. The new assistant, which is powered by its latest AI model, Llama 3, is integrated into their family of apps, Facebook, Instagram, and WhatsApp, could help Meta better compete with competition in this Gen AI space from OpenAI and Google. Meta supports open ecosystem for AI and virtual reality. Management expects AI model training improvements will come from the open source community and added that improving cost efficiency is one of the main areas that open sourcing will help. A similar open ecosystem approach will help Meta expand the virtual and mixed reality headset market over time as well. Overall, Meta's stock sell off after their Q1 earnings release can be attributed to two main factors revealed during the call. Number one, lighter than expected revenue guidance. While Meta reported better than expected profits for Q1, their forecast for Q2 revenue fell short of analyst expectation. The company predicted Q2 revenue to be in the range of 36.5 billion to 39 billion, with a midpoint of 37.75 billion, which stood out to be below analyst estimate of 38.3 billion. Number two, focus on their long-term investments. Investors grew concerned after CEO Zuckerberg spent a significant portion of the call discussing Meta's investment in areas like AI and metaverse. These ventures are currently unprofitable, and investors seem to prioritize short term gains over long term vision. Now, here is an interesting development that has recently taken place that could benefit Meta significantly, which is the ban of TikTok. Biden has signed a bill that would ban TikTok if it won't sell their social media service over privacy and security threats. Here is what happens next. ByteDance has nearly a year to diverse or face a ban. ByteDance is going to challenge the ban in the courts, and the ruling could take several months or even years to take effect. TikTok has an install base of 170 million American users, especially young demographics. They tend to spend around 53 minutes per day on the app. This compares to 34 minutes spent on Instagram and 32 minutes on Facebook. In the scenario, TikTok gets banned, a majority of that 53 minutes usage could directly result in an increased usage of Facebook and Instagram apps. Now, before we talk about Meta's valuation, it's important to understand its moat and risk the business has in the current market landscape. Most people think that investing is just about valuing businesses and their finances, but the real key is finding businesses that will perform for decades to come. Valuation is important, but it comes after you have studied the moat of any business. A moat is understanding a business's competitive advantage. Now, coming to Meta, it has one of the widest moat I have ever seen. It has habit forming products that billions of people use daily, and millions of advertisers spend billions on the platform to make some sales. Meta's moat is a combination of factors that give it a competitive advantage, which is due to its network's effect and a massive data trove. The network effect is a big one. With billions of users on Facebook, Instagram, and WhatsApp, it creates a strong incentive for new users to join the same platforms where their friends and family already are. This makes it difficult for competitors to gain traction, as it's really hard for other companies to offer something similar when Meta already has so many people. Next one is a mine of user data. Meta has access to a tremendous amount of user data on demographics, interests, and online behavior. This allows them to deliver targeted advertising, which is very attractive to businesses. Replicating this data collection effort would be a huge challenge for any new entrant. These factors together create a strong competitive position for Meta, making it difficult for competitors to replicate its success and challenging for new entrants to penetrate the market effectively. Overall, I think Meta has a very wide moat. However, there are some risks to consider when evaluating Meta stock. First one is on the regulatory front. There has been increased government regulation that could limit Meta's ability to collect and store user data, potentially impacting their advertising business. Meta isn't just facing regulatory headwinds. New social media platforms like TikTok are capturing user attention, especially among young demographics that could erode Meta's user base or advertising revenue if Meta can't adapt to new trends. The metaverse bet adds another layer of risk. While it has the potential for long term growth, the ongoing investments are a drag on the company's resources in the short term. If the metaverse doesn't take off as expected, it could significantly weaken Meta's position against competitors. Now that we have discussed Meta's widening moat and its dominant position around its business enables it to achieve great financials. Meta has a whopping 10-year revenue CAGR of 32.84%, 10-year earning per share CAGR of 38%, gross margin of 81%, and operating margin of 38% from its most recent quarterly release, which is one of the best in the industry. This translates into forward PE of 21.5, PEG ratio of 1.16, shareholders yield of negative 0.5%, and debt to equity ratio of 0.25. Now, let's talk about its hypothetical valuation. But before we go into the details, I am not a financial advisor, and this is not financial advice. Please do your own research before making investment decisions. So, using my hypothetical valuation framework, let's analyze where Meta stock is going from here. Of course, the stock can go way higher or lower from here depending on how they execute and market sentiment. So, looking at Meta's past quarterly results and management's guidance, I have made some assumptions here to come up with a hypothetical price return with an investment period of 4 years. My low case assumes an annual revenue growth of 10%, operating margin of 36%, share repurchase of 1% with a PE multiple of 20. This leads me to a hypothetical annual return of 2.83% based on current share price. My base case assumes an annual revenue growth of 12.5%, operating margin of 38%, share repurchase of 1% with a PE multiple of 22.5. This leads me to a hypothetical annual return of 9.85%. My bull case assumes an annual revenue growth rate of 15%, operating margin of 40%, share repurchase of 1% with a PE multiple of 25. This leads me to a hypothetical annual rate of return of 16.74%. I personally think it should be somewhere in between base and bull case as I look ahead with the anticipated rate cuts by Federal Reserve in 2024 combined with major elections in key markets like US and India and potential of TikTok ban which should create a positive tailwind for Meta's advertising business. These factors position the company for potential new highs in the coming year. Overall, I believe Meta presents an attractive entry point here. Meta is my third largest position, and my plan is to continue to hold and buy more on any pullback. If you like this video, please give a thumbs up and subscribe to my channel.